Good evening, everyone out there in annuity land. This is Stan, the Annuity Man, with my co-host, Jimmy.Direct, and we really appreciate you showing up for one of the greatest titles of a webinar ever. It's already won the title for that. Sex, Lies, and Income Riders. We're going to cover all three, primarily the income rider side. But before we jump into that, I'm going to throw the ball over to Jimmy.Direct to tell you about Annuities.Direct. This is the promotion part of the webinar, but you need to listen closely. Jimmy.
I want to welcome everybody as well. Obviously, Annuities.Direct, we're the direct-to-consumer source for annuities. So we want to make you aware we're getting ready to make a couple of changes on the website to make it easier to use. I know some of you will be happy to hear that, but those should be out in the next 2 weeks. And then Ask Direct is if for any questions that you have here at the top, you just click on it. It'll take you to a page where if you have questions about anything we cover tonight, they come directly to Stan and I, and we'll be happy to answer any of those questions that we don't get to on the webinar tonight. Feel free to log in, ask questions at any time. We'll get to them as we go through the presentation. If you want to follow along with the replay of the webinars or initial plays of the podcast, you can go to GoDirect News. You'll see all of the information right there, all the articles, all of the pages of material that we've produced over the last couple of months are all there. So if you haven't taken advantage of that, please do. And if you'd like to get a live quote for a SPIA, DIA, QLAC, MIGA, you can do so right here at the top of the page under Get a Quote. And, of course, my mouse isn't, there we go. You can see that right there. You can just click on whether you want QLAC, SPIA, DIA, or MIGA, and you can run your own quote. So with that, Stan, let's go.
Here we go. So let's talk about lies. A lot of people lie, especially top politicians. Let's talk about sex. I think we're all for it. So let's now get to income riders. Income riders, in my opinion, are the most missold thing in the universe, because if you turn on the television, these gunslingers up there talking about they've got the annuity that'll get you 25% more or 40% more of this and that. And some people don't even use the word annuity. Some guys will stand up at a bad chicken dinner seminar and say, I can get you 7%. Hopefully you're smarter than that. That with the 10-year Treasury right now hovering below 1.5, there's no genius at an insurance company that can get you 5, 6, 7%. Now, when you hear your annuity agent talk about 5, 6, 7%, or my income stream, the new one is my income stream increases with the index option, those are called income riders, okay? An income rider is an attachment to a deferred annuity. Typically, it's an index annuity, which is a fixed annuity, fixed index annuity. You're not going to get market returns. We won't go into that. And a variable annuity. So index annuities and variable annuities, you can attach income riders. You don't have to, but income riders are a guarantee for future income. That's it, period. We call it income later, so you can do it two ways. You can either use a longevity annuity, or you can use an income rider attached to a deferred annuity, index, or variable. Both of those products, longevity annuities, deferred income annuities, are the same thing, and income riders get you to the final destination of income later, but just take a different path to get there. We only look at contractual guarantees. So with income riders, I mean, there's tons of them out there. They're commodity products. Nobody has the best income rider. I hate it when people say that. When you look at income riders, what you're doing is you're, in essence, drawing the line down the middle of a blank sheet of paper, left-hand side being the accumulation side, right-hand side being the income rider side. And the income rider side is the guarantee. So if you're going to defer for, say, 10 years, we know to the penny on that right-hand side of the ledger, the income rider side, what that guaranteed income stream is going to be, period. So one of the things that's happening out there that drives me crazy, and it's especially with the TV guys, the guys who run all the TV ads. I'm sure they're really nice people. I'm sure their mother makes a really nice egg salad, but their ads stink. And what they do is they will say, well, here's your income rider, and even if you need income right now, you need to buy an income rider. That's just complete and utter garbage, and it's financial malpractice. If you need income now, you need to buy a SPIA, which is an immediate annuity. We've done a webinar on that, and you need to go and listen to that. But if you're looking to defer, meaning to wait, that's what defer means, wait until you turn on the income stream, then an income rider could be appropriate. It's a flexible choice for the people out there that are planning for income but want to have the flexibility of if they get to that time period and they don't want to turn on the income, they don't have to. So if someone's pitching you an indexed annuity to turn on right now, you're buying that agent a car. You are buying them a car or some type of trip to Bora Bora to drink for free. There's no way they shouldn't be showing you a single premium immediate annuity if you're turning on an income stream within a year or two. Okay, anything past that, that's what income riders are for. Jimmy Dot, jump into that rant that I just went on.
Well, it's interesting because the fact that, so many of these are missold by people saying, well, you've got the upside potential of the, accumulation side of the annuity to offset the income stream that you're taking. And as I know you're going to get into in this webinar, that's just not true. So as Stan says, if you're 13 months or less away from wanting to turn on the income, you have to look at a SPIA just because the SPIA income stream will be more times than not, 9 times out of 10, higher than what you're going to get with the income rider off of index annuity.
Definitely. And if someone's not showing you SPIA, then they're just doing a straight commission play. So let's kind of dig in there to the next slide. And if you have any questions, shoot them to us, and we'll try to answer them on the fly because I can multitask. So next slide. Income riders, what's the cost for an income rider? Here's what happens. Going back to the drawing the line down the middle of a blank sheet of paper, left-hand side being the accumulation side, that would be index options for the index side or a variable annuity mutual fund. That's the left-hand side. That's where the fees from the rider are taken. In other words, the right-hand side of the ledger is going to grow by that specific percentage or whatever the guarantee is on that side, but the fees are not going to come out of that. Now, rider fees, you have to understand, are taken for the life of the policy. And interestingly enough, the vast majority, the last time I saw this stat, it was pretty staggering, but over 50% of the people that have riders never turn them on. So you ask yourself, why do insurance companies have the big buildings? That's the reason they have the big buildings. They're providing this benefit and no one accesses it. I think a lot of the reason for that is people think that, the guy stands up there at the Bad Chicken Dinner seminar and says, I can get you 7% and a 10% bonus. Well, we all know about bonuses. You don't buy an annuity for a bonus. It's like buying a car for the stereo system. And the income rider, who cares about the percentage? It has nothing to do with that. It has to do with the guarantee at the back end when you take the payment. And remember that every time you turn on income stream with an income rider, they're basing that payment on your life expectancy at the time you take the payment, or life expectancies if it's joint at the time you take the payment. It's that simple. So those little AARP things you get in the mail with the 7.2% or 6.3%, that's not yield, Chester. Okay, that's not yield. That's your actuarial percentage based on your life expectancy. My apologies to anybody out there named Chester. Jim, is there any way to blow that up or not? What am I looking at here? Take it from
big as you're going to get.
Small. That's it, huh? And I'm assuming that I'm not seeing a lot. We're showing on this that you're putting in $300,000 and the roll-up rate. Go into the roll-up rate. That's the right-hand side of the ledger. That's the 5% right there, where Jim's pointing to. That's not yield. That's where the income rider on the right-hand side is growing by. And some of them are 5, 6, 7%. Just because it's 7% doesn't mean it's going to be the highest payout, by the way. Don't get fooled by any of that. And then it will show the income base and what it's going to grow by. So you put in I think the $300,000 at the end of year 10 is worth $488, and then you see the income total amount is $30,542. Okay, so that's contractual. That's worst case scenario. That's Brexit. That's everything. That's the world ending. Okay, and anybody that comes out of there and says, hey, I'm going to get you an annuity that is going to increase every year when the index moves up. Well, there are some out there, but insurance companies have the big buildings for a reason. They're just going to lower the payment if you choose something like that, and it's not guaranteed. Jimmy Dot and I believe that you own annuities for contractual guarantees. What it will do, not what it might do. And if you're going to buy one of those potential hypothetical, theoretical, back-tested dream pitch scenarios of an agent, you're going to pay for it because it's typically a 4 to 8 year break-even point depending on your age to get back to, say, in this case, the $30,542. that you could have gotten without all those whistles and bells. Anytime you attach a cost of living adjustment rider increase or a CPIU, consumer price index increase, and you can with some riders, not all, or if you say I just want an index option increase, and they're doing that, insurance companies are doing that so they can lower the payment initially with this hope and dream and the unicorns chasing the butterflies that things are going to increase. I believe you just go with the highest contractual guarantee and call it a day. So with this slide, and you can go back and look at it, one of the things I want to point out as well, and we'll cover this later, is go to the right-hand side where it says enhanced benefit, where it says 48,000, whatever. A lot of the stuff that's happening out there is the gunslingers will say, oh, I can get you free long-term care without any exam. Well, hopefully you're smarter than that. If you're not, then you probably shouldn't be on this call. Or it's good that you're on this call because it isn't long-term care. It's confinement care, and what they do is they just give you your money back quicker. Okay, and typically it's for a 5-year time period max. So if you can't do two of the 6 daily functions, which is clothe yourself and feed yourself, I mean, life stinks anyway, you're going to get more of your money back quicker. Big deal. I don't think you make a decision based on confinement care doublers or enhancements. You make your decision based upon the lifetime income stream. If the lifetime income stream's higher, great, that's it. But this isn't long-term care. For long-term care, which is the best coverage you can get, traditional long-term care, you've got to get blood tests and medical tests. Don't let the gunslingers tell you can get it for free, because there is no free. Jimmy, jump in.
Well, I think it's important that you understand the two sides, which are outlined in the purple. The income rider side is very important that you understand what you're buying this for, which is the deferred income, as Stan said earlier. So you're looking for what you're going to get down the road. You're not looking at this column right here, which everybody wants to lean to, which is the interest or the growth. As you can see, this is run at 0. In other words, this is assuming that the policy earns nothing. This is what the income stream is guaranteed to be. If it earns more than that, then there's icing on the cake. But this is looking at things from the worst case scenario, which I think is the only way you want to look at an income rider on these products.
Absolutely. And the other thing on the left-hand side of the ledger, we don't even look there. I mean, we only look at the right-hand side of the ledger, which is the income rider side. And by the way, we're a little preemptive here on the income riders, but with the ads that have ramped up since the DOL rule, and you have all the gunslingers really running these ads big time, we needed to address this. We're going to have an income rider.direct. It will be up sooner than later. We're going 122 miles an hour right now to get there to where you can get live income rider quotes. You can just email us now, and we'll get them to you, a day later. I mean, I don't care what we got a staff that's the best in the business. We'll turn it in a day later. Just say, hey, this is the money, this is the amount of money, this is how long I'm going to defer for, here's the dates of birth, and we'll get it for you. So with this, let's move to the next one. Shoot the questions in. We're going 100 miles an hour, just trying to get everything in. Jimmy Dot and I call income riders monopoly money. It's a phantom account, okay? People always say, well, if they stand, I just bought an 8% annuity. No, you didn't. You bought an income rider that might have a credited percentage annually of 8%, but you can't peel off the interest. You can't take it lump sum. You can't transfer it. You can only use that amount for income. And I think a lot of people out there that are uninformed, uneducated dreamers looking for the next Madoff, they're thinking they have a high yield Jimmy Carter type yield. It doesn't exist. With the 10-year Treasury at 1.5, hello, there's not a genius out there that's figured out how to get you 5 to 6 to 7% true interest. Jimmy Dodd has come up with something called earned income credits, which I think that's it. That's what an income rider does. You're getting earned interest on that right-hand side that you can use for income. Okay, that's the way that you need to look at it. But you can't get to it. You can't transfer it, and you've got to use it for income. You've got to transfer that risk to the annuity company with the that's issuing the rider, and transfer that risk to pay them for the rest of your life. Now, a lot of the stuff out there that agents will say is, well, if you look at the left-hand side and the right-hand side, if the left-hand side's higher than the right-hand side, then you get to choose the higher of the two. Well, I'm just here to tell you, that's just cockadoodle. 99% of the time, the left-hand side of the ledger, which is the accumulation walkaway amount, will never be higher than the right-hand side. Why do you ask? Good question. The reason is annuity companies have the big buildings and they have the logos on the planes for a reason. They want to make sure that that right-hand side, that monopoly money, that phantom account, that income value account that can only be accessed for income is much higher than the left-hand side walkaway amount. What does that mean? That means you have to stay in the policy to access that right-hand side. So that's the reason that Jimmy Dott and I don't even look at the left-hand side, don't even look at the potential, hypothetical, theoretical, projected, back-tested nonsense. We look at the guarantee on the right-hand side, and that's where we base our decision. Jimmy?
I mean, when you look at this, I think that you have to really look at an income rider for what it says. It's an income rider that you add to a deferred annuity so that you can have a guaranteed income. Outside of that, everything else is just distraction from my standpoint. It's like the old days when you watched the TV with rabbit ears until you got them in the right position, it wasn't clear. And when you want to look at an index annuity, you have to look at the fact that you're buying the income rider, you're deferring it, you're earning income credits for as long as you defer it at a specific rate per year, but you only get that money if you turn the income on. And Stan alluded to earlier how few people actually turn the income rider on, and that to me is kind of interesting from the standpoint that you buy it for a specific reason, but then you never act on the specific reason, and that's where I think the disconnect is to how these products are designed.
Well, and the annuity companies know that. They know there's going to be a procrastination effect out there, that they're going to offer a benefit and they're going to charge you for life for that benefit, and most people will never access it. So if you're going to buy an income, if you need future income and you attach an income rider, then access it. It's a similar decision that you'd struggle with Social Security. Stan, Jimmy, what's the best time to turn on Social Security? I don't know. You know, because you know when you need the income. It's the same thing with income riders. The older you are, the higher the payment. Same with Social Security. The older you are, the higher the payment. Social Security has an implied or an earned interest credit, right? The longer you wait. Same thing with an income rider. So for all those pundits out there that say, I hate annuities, all those guys running ads, hello. It's Social Security. It's the same decision. So look at it like that, okay? And just like Social Security, if you don't access it, then they're not going to pay you the income stream, right? So you can sit there and watch it accumulate and go, you know what, when I turn 70, it'll be, well, maybe you're 66 and you want to turn it on right now. You have to factor in, there's no good time to time it. You can't look at interest rates. And yes, interest rates do affect income riders and the percentages that right-hand side of the ledger grows by. It just does. It is what it is. But if you're trying to time interest rates, especially after this Brexit thing, at the time of this taping, Brexit just happened where England just kind of threw a dart at the whole thing. But it'll be interesting to see what happens. But you can't predict any of this. Jimmy, what's your thought on the interest rates? I know a lot of people out there go, well, I'm going to time it because the interest rates are low right here. What would you say to that?
I'd say good luck. Everybody's been telling, you have to understand, I'm in the process of writing an article about the fact that 3% 5-year fixed rates pretty much after Brexit are done. You're not going to see at 145 on the 10-year Treasury, how are we going to pay 3% going forward on 5-year rolling rates? It's just not going to happen. Look at what's going on in the bond market. Prices have gone through the roof because values are down. Money's coming out of Europe to the U.S. markets. Will it stay? That's still an unknown. But I think what you got to really sit back and look at is, what do I need to do today? Everybody can pontificate what's going to happen 3, 4, 5, 7 years from now, but what do you need to do today? Do you need the income today? The old adage, we're not promised tomorrow, we're only promised today. And I was speaking with a client this morning who's 85 years old that wants to know if they should turn on their income rider. They should have turned it on 6 years ago, but they keep waiting because they think they're going to get more money. And in the end, how much longer are we actually going to live, and quality of life that we can enjoy the money? I think those are the key elements to me as to how you plan it.
Yeah, don't get enamored watching your phantom account grow. Seriously, that's really what it comes down to. What's the next slide, Jimmy?
Annuitize.
It's good. This is a question that we get a lot, and you can. Annuitization is what everybody thinks annuities are, meaning that you give up control of the money and the insurance company pays you a lifetime income stream. That's annuitization. That's a single premium immediate annuity. That's a deferred income annuity. Those are annuitized products, okay? But income riders, the vast majority of them are not annuitized products. They're drawdown, and in English, drawdown means subtraction, okay? So let me repeat that. Drawdown means subtraction, meaning that when you go back to the left-hand side of the ledger and the right-hand side of the ledger, when you take an income stream, whatever that income stream is, they're going to they, meaning the carrier, will subtract that amount from the left-hand side of the ledger and the right-hand side of the ledger. So you're drawing it down. You're not annuitizing it. Now, there are specific riders that can be annuitized. They're typically attached to variable annuities. They're called GMIB riders, guaranteed minimum income benefit riders. Those are annuitized, okay? But those aren't very popular because they're not very competitive. And by the way, I've written a book on income riders. It's an income rider owner's manual. If you want one, we'll send it to you for free, okay? Hard copy. It's a 56-page quick read, but it's everything about income riders on the planet. It's won awards, Jim. I don't know if I told you that. It's won awards national. But I'm just saying, we have the information if you want to dig deep in the income riders, get quotes, etc. But the interesting part about annuitization versus drawdown with income riders is you retain full control of the asset, meaning that if you turn on an income stream with an income rider that's a drawdown, not annuitized, and the income stream continues, you can stop it and say, you know what, send me the accumulation value, I'm done. With an annuitized product, once you've ripped the knob off of that water faucet is flowing. Everybody understand that? With annuitization, once you turn on that switch, the switch is there permanently. With an income rider that's drawdown, you can flip that switch on and off. Okay? And let's just say you wanted that some tax law went crazy, some progressive got into office and wanted to raise all of our taxes, and you had turned on your income rider. With the drawdown type income rider, which is really the only ones that Jimmy and I like because they are competitive from the standpoint of the payout, you can shut that baby off. Now, when you turn it back on, it's going to turn back on at the level that you shut it off, but who knows what's going to happen in the future. One of the good things about income riders is the product is flexible. It's flexible. If you said, Stan, I want to buy an income rider and I want it to turn on in 10 years, you could get to the 10 years and say, you know what, Stan, let's defer it another 2. Or you could call me up 3 or 4 years earlier and say, Stan, I need the money now. Let's turn on the income stream. That's the good news about an income rider. It's flexible from a lot of standpoints, but you still retain full control over that asset. What do you think, Jim?
I like income riders. I think one of the greatest challenges has consistently been understanding what they're there for. In other words, when you sit down and you say, all right, I'm buying a deferred annuity, and I'm going to turn an income stream on in year 10 or year 5. And when I get to that point, the ideal is that if I don't need it and I'd like to defer it for 2 more years, I can. Or vice versa. If I need it in year 4 instead of year 5, I can turn it on. So the income rider allows the flexibility that a lot of people are looking for. The drawback is that we confuse that earned income credit that we get towards the income stream with actually that it's our money when it's not your money. It's an earned income credit. It has nothing to do with whether or not it's your money. The only amount that you get is on the accumulation side, and that's where the confusion comes in, and that's where all the, shall we say, the lies part of tonight's presentation comes into play.
Yeah, because, I mean, this is where the annuity business, this is the reason the Department of Labor has stepped in and said we're going to regulate this stuff, because the lies and the misinformation on income riders is so bad that they just said we're done. And I know a lot of people that said no, it's this government power trip. Yeah, maybe, but they could validate the power trip because of the sales practices that were going on when people are on television showing 8 and 7 and 6% numbers and people thinking that's yield. One of the things you understand about income riders, typically, they're not issued until you're 40 years old. So 40 and up, you can get them. And some income riders can defer as long as 20 years. Typically, the longest period is 10 years. And then if you want to continue, you can just re-up at that time and continue for another 10-year period. So, you could be a 40-year-old and defer till age 60. Okay, so you can use income riders and defer for a very long period of time, but that is contractual. So, for instance, let's just say you bought a 10-year rider. You bought a rider, it's guaranteed for 10 years. You said, Stan, at the end of the 10 years, I want to continue the rider. Most of them will reprice it there, and you'll have to buy another rider at that time, whatever the earned income credit is at that point in time. But what I'm trying to tell you is young people can play this game, and we have a lot of entrepreneurs that they're using this as a future pension, which is, it's the way Jimmy Dot and I use it. We use these things for future pension if we ever decide to go on the boat or the Learjet that we haven't bought yet. So you can use it for a future income day. And a lot of my income riders that I own, I'm planning on turning them on at 65, 66, 67, and just laddering that income with the income riders. So we did the draw line down the middle of the page. That's the easiest way to understand it. Let's go over it again. Draw a line down the middle of a blank sheet of paper, conceptually or real time. Left-hand side is accumulation value. Accumulation value means walkaway amount. It means on the variable annuity side, the mutual funds, the separate accounts, whatever they want to call them, they are mutual funds. Or an index annuity is index options. That's going to give you a CD return, not a market return. That's the left-hand side of the ledger. That's where the fees come out of. That's the side that if you say, Stan, I'm out of here. I want my money back. I don't want to use the rider. Send me my money. That's where they're going to take it from. Okay? The right-hand side of the ledger is the income rider, and it could be as high as 7, 8, 9, 10% on the income rider. That doesn't mean it's going to be the highest payout, but that's the earned interest credit there, that you're going to get on that side that you can only use for income. Two separate calculations. So if you get your statement, you're going to see surrender value, accumulation value, income benefit value. Okay, just don't get enamored with the income benefit value because you're not going to be able to access it in any form other than an income stream. Now, some income riders, I would say 5 or 6 of them out there right now, they also, that income rider side, that right-hand side of the ledger, can be used as a death benefit as well. So if you want to do kind of some double planning of, Stan, I want a future lifetime income stream, but I also would like that side that's growing to be a death benefit, we can go find you those. They're getting fewer and fewer. There's a few out there, and they're not perfect. They have little asterisks and hoops you got to jump through. But in some cases, that right-hand side of the ledger is a death benefit that can be paid out over a 5-year time period to your beneficiaries. So you can kind of kill two birds with one stone, no pun intended. But riders, they're commodity products. Nobody has the best one. No carrier has the best one. We quote everybody just to see who has the highest contractual guarantee for your specific age and situation. It's not going to be the same with every single carrier. And a lot of the big carriers, for whatever reason, they've decided not to play in the income rider game. So some of your favorite names don't even offer them. So, Jimmy, what are your thoughts on that?
Well, my thoughts really are that, a buyer beware type of thing, in that if somebody's running this column right here on a ledger, which is the accrued accumulation side, in other words, what is it growing at? What's the rate of growth of that side? If they're running that above 0 or even above 2%, I would be very, very cautious about the illustration, because remember, these are calculated in a methodology tied to an index. So you don't even, Stan and I don't even get into that, because my eyes roll in the back of my head, and I trade stocks for a living. So it's just, it's a mind-boggling to me that when you get into the point-to-point and, all these different indexes out here, and buy this, buy that, and this flip-flop and all the other things, buyer beware. This is a product that was originally created that in a perfect world, if the markets go up, then maybe, just maybe, you get a bigger value. But this product was really created for the income side to give you a guaranteed accumulation that when you turn the income on, you know what the income's going to be in that year, guaranteed for the rest of your life. Goes back to the original premise. You buy annuities for the guarantees, not for what they might do. This is a one big question mark. This is nothing other than a big question mark. This is the guaranteed side, which is why we talk about it, because that's what will happen, not what might happen, as Stan is so famous for saying. But don't get caught up in the left-hand side of these illustrations, because they really are, it's sort of like looking at a hypothetical illustration for a mutual fund over 10 years. It's all hypothetical. We're never going to repeat that twice in any given lifetime. But what's on the right side of these that's not on a mutual fund hypothetical illustration is the guaranteed income stream and the guaranteed earned income credit that you're going to derive the income from over your lifetime.
And one of the podcasts we recently did was with Cheryl Moore, who's a friend of Annuities.direct, and she calls herself the index rock star for index life and index annuity. She knows her stuff. And what she said on our podcast, you need to listen to it. She said, any proposal that's not guaranteed that an agent shows you will never, ever come true. She said, I want you to think about that. So anybody out there that say, well, Stan, they showed me the back-tested numbers on the fill-in-the-blank index company, and they look pretty good. Yeah, so what? Who cares? That has nothing to do with anything. Do not buy these index annuities for return. Buy them for the guarantees. Now, with that being said, Jimmy Dott and I are on the inside. We're the big hitters in the industry, right, Jim? I mean, at least we tell ourselves that. But we have been told by the uppity-ups that later in the year, probably first of next year, there will be some very pro-customer index annuities, which, of course, you're going to be able to get on Annuities.direct, that is going to strip out a lot of the cost, distribution, all the nonsense out there, in essence be kind of a no-load indexed annuity, for lack of a better phrase. So if you really believe that you want an indexed annuity for index option returns, keep your powder dry, okay, because there's better products coming. But if you want income in the future and you want to know exactly to the penny what it is, then we're going to use an indexed annuity in current form as the delivery system to get you that guarantee. So you can't have your cake and eat it too. You can't have market growth and income. I don't care what anybody tells you. And there's a lot of people that are saying that out there in order to drive nice cars. It just doesn't exist. So, Jimmy, have we got any questions that anybody's lobbing in? Because at this point in time, I've at least been threatened twice by the public.
A lot more than that.
Good. Excellent.
One is what happens to the, I'm going to call it my phrase, the earned income credit once you turn the income stream on?
Good question. So let's just say that's a 7% income rider that's growing by 7% per year that you can only use for income. Once you turn on that income stream, poof, gone. Never to be seen again. Even if you shut it on and off, you're not going to get that earned income interest growing again. It's not going to happen. So once you turn on the income stream, that's it, locked in, and that's where your payment's going to be, and that's what the payment amount's going to be. And again, in most cases with income riders, the ones that do not have increases, either index collars or CPIUs, are going to be much, much higher than the ones with, because insurance companies don't give anything away. Next question.
You know that it's coming. Fees, and where are the fees?
Fees come out of the accumulation value, and they're all different. There's no uniformity in the annuity industry. You know better than that. Fees on an income rider are going to range anywhere from about 0.5% of 1%, that's 50 basis points for those of you who have a master's degree, or up to 1.5%. So it's typically 50 basis points, 0.5% to 1.5% annually for the life of the policy taken out of the accumulation side. So the 7% growth, the earned index growth, what'd you call it, Jim? I like that.
Earned income credit.
Earned income credit. I like that. The EIC. The EIC, earned income credit of 7%, that fee is not coming out of that right-hand side of the ledger, but it's coming out of the accumulation side, which is the might do side. We don't know what that's going to do. We really don't care. So that's where the fee is coming out of.
And
it just depends on the carrier. Yeah.
You can see it right here on this illustration. That's the column right next to the zero.
Yep.
They put it in dollar amounts. Those are the annual fees that are charged based on the accumulation value.
Oh, and here's a fun one that nobody, even agents, there's agents out here that's going to hit themselves so hard in the head when I say this, they're going to knock themselves out. I want you to look at that fee column. Do you see it going up? Does everyone see that going up? Nod your head. Great. You know why? Because the fee is based on the phantom account. The fee is based on the right-hand side of the ledger. The fee is based on the earned income credit. Hello, agents out there that are listening to me. You need to tell your people that. So the longer you defer your income rider, the higher your fee is going to be. Why? Because it's growing by that earned income credit percentage, which is increasing the fee. Hello? How about that? I guarantee you I'm the only cat on the planet besides Jimmy.Direct that knows that in the industry, or if they know it, they're not saying it. So that's the reason and the motivation for you to have a specific target date and turn that darn thing on. Because if you fall in love with watching your phantom account income rider right-hand side of the ledger grow, you're also falling in love with higher fees. Because they're going to base that 50 basis points or 1.5% on that right-hand side of the ledger. Sorry, Jim.
But also note that the fee doesn't stop.
No.
When you turn, once the income comes on, the fee doesn't stop. You can see that it stays the same throughout the life of the policy, which goes back to the earlier point that Stan made, is if you think this side's going to grow larger than this side, it's not going to happen. I mean, it's just the odds are dramatically against it.
Or, and a lot of guys will say, well, Stan, however, if the index side increases and is higher than the right-hand side of the ledger, then I'm going to get that. That can only happen for 1 year. Because once it's drawn down, once the subtraction starts, it's mathematically impossible with all the caps and spreads and all that nonsense. So just don't fall for the too good. You're smarter than to fall for the junk that's being pitched out there. Income riders are a fantastic strategy if you understand them for their benefits and their limitations. Key is the limitations. Know what they don't do, okay, and know what they aren't. And then you're going to place them correctly and in proportion and appropriately within your portfolio and your plan. They're for future income, and it's a flexible strategy for future income. Nothing more, nothing less.
Does commission come out of the contract on an annual basis that you get, Stan? Only you get it?
No. Annuity commissions and life insurance commissions, because, by the way, annuities are life insurance issued by life insurance companies. All those commissions are built into the policy. I don't like that. Jimmy Dot and I don't like that, but it is what it is. It's the way that the industry has done it forever. In other words, you're never going to see it. It's paid. The commissions are paid from the annuity company reserves. So if you put in $100,000, you're going to see $100,000 on the left-hand side of the ledger and $100,000 on the right-hand side of the ledger. And regardless of it, whether the agent chooses a one-time commission or a trail commission or whatever they choose, you'll never see it. Now, obviously, the gunslingers out there going, well, there's no commissions. Of course there's commissions, for gosh sakes. Have you met my wife? She likes to fly places and go to places where they don't speak English. So, of course, there's commissions, but it's built into the product. I really wish that the industry would go straight transparent, but they have decided not to do that. I think eventually they will.
Explain the benefit rate, Stan, right here, and if there's a minimum that you should look for at any specific age.
No, there's no minimum. The benefit rate, the income amount, the 3542 is just the guarantee, and the 6.25%, that is what, I think that's the question, that is the percentage based on your life expectancy. That's not yield. That's 6.25%. That's your life expectancy. That's what they're projecting you to live. Okay, that's 6.25% of the total. And if you divide that out, you'll figure out that their actuary sitting in the closet, that's when they're pinpointing you to keel over. And you're saying, you know what, I'll take that bet, and if I live longer than that little nerd in the closet, then you guys are on the hook to pay me. That's an annuity transfer risk in a nutshell, period. And that's what that means. Now, going to the 6.25 and the 3542, here's what you tell any agent, including us at Annuities.Direct. Go quote everybody. I want to see 5 to 10 quotes. I want to see the top. Don't show me one, because if they're showing you one, they're either stupid or they're trying to go on a trip. That's it. No other. If they're only showing one income rider when you ask for an income rider, they're either stupid, which could very well be, or they're trying to qualify for a trip, car, Super Bowl ring, or something. These are commodity products. You've got to shop all carriers to see who has the highest guarantee, because some carriers want 65-year-olds and some carriers want 70-year-olds and some carriers want 72-year-olds, and they're going to price it accordingly to be aggressive. So just understand that.
And also be aware of the fact that this column, in a lot of illustrations, this one happens to not have it, but at whatever point you want to turn it on, it'll always show you what the rate is at 6 1/4, 6 1/2, 7, 7 1/2, and it does go up the older you get. So don't play, the roulette wheel of trying to say, well, I'm going to wait till it's at 7 1/2 and turn the income on when I'm 83. Turn the income on when you need the income. This isn't a lottery. This is actually designed to turn the income on when you want it. So don't get caught up in all the numbers and trying to win relative to what's there. So look for, how these are made relative to what they are. Stan, another question is about credit ratings relative to the insurance companies, and what's the lowest credit rating you would look at relative to these, because you are looking at income?
It's tough on the income rider side, and we do. You can't do a hard Comdex ranking, okay? Or you can't just say anyone A or better, A plus or better, or whatever. Jimmy Dot and I, because we've been around the block a little bit, we look at solvency ratios. We read their balance sheets. We have subscriptions to Vital Signs, which gives us some internal look to all carriers. But we do look at the claims paying ability of the carrier to give our recommendation, and that doesn't mean that everyone who's A minus isn't going to get our stamp of approval. Some are and some aren't. So you just need to run the carrier bias. And for anyone who's talked to me or has talked to Jimmy Dot, we are brutally honest. I mean, brutally honest. Walking middle finger of annuity truth. I'm going to tell you what it is. And I'd love one of my clients. My clients will tell you, and if you ever meet one, they'll say, "Holy crap, he's not your friend, but he's going to shoot it straight," and that's all you want. You can talk to me at any point in time. Eventually, with Annuities.direct, if you find an income rider, we shoot you an income rider, you want to go through the process, you're going to have a licensed sales assistant walk you through the paperwork. If you need to talk to me, then talk to me. Don't be afraid. I'm not going to pitch you. I'm going to tell you the truth. I'm going to give you the benefits and the limitations. But from the standpoint of ratings and claims paying ability, solvency ratio, there's no perfect answer. I can't sit here and say, well, everyone 80 and above or everyone A plus rated. It's a little bit more complex than that, but we do use Comdex and we do use the internal balance sheets of these companies because between Jimmy and I, we've been around the block a lot. I mean, I'm 60, 70 years of experience. We can read this stuff, and we understand bonds. We understand bond holdings. We understand if they're too long on the bonds. We get all that. So we make some pretty hard calls on what they're doing. And we have found some A-minus rated companies that we were in touch with a 10-foot pole because some idiot in the bond buying department of that carrier is going too long, and they're going to get whacked if rates ever move. So,
this is your favorite question, I know. Can you comment on Allianz 222 and the protected income value relative to the guaranteed bonus?
No, I'm not going to do that because they're waiting for me. You can call me direct and email me. I'll set a time to talk to that person because in order for me to talk about a specific product on a webinar like this, I have to get approval from Allianz to do that, and I will not do that. But I will talk one-on-one with you on any product that you have because I know them backwards and forwards. I know those products like the back of my hand, so I could tell you exactly what they are and what they are not, but I will not do it on a national setting like this because I know it's hard to believe there's a lot of people out there that don't like Stan the Annuity Man. Can you believe it, Jim?
I've never met anyone who doesn't like you.
They just don't understand me, Jim. They don't get me. They don't get me. I just can't do it just because we do these webinars because we're not going to get it approved by these wackos, internal compliance people, because we're not going to talk about their product. But I will talk to you one-on-one about it, no problem whatsoever. So just contact me.
All right. I need you to finish. COLAs and index increases.
once again, let's talk about, the stars and the planets aligning, and Stan, it sounds so good. And the best inflation annuity on the planet, all of you already own. It's called Social Security. Now take your tinfoil hats off for a second, and don't hit me with some conspiracy theory about the Fed being off this, located on some island in South Carolina. I don't want to hear that crap, okay? You own the best inflation annuity on the planet, and that's Social Security. Why? Because it's a political football, and they just raise it. They just say, okay, let's just raise it. Let's just raise the. It doesn't work like that with annuity companies. When you add a cost of living adjustment, COLA, or a CPIU, Consumer Price Index increase, or an index increase, with some of these index annuities, they're trying to get fancy and saying, well, our income's going to increase with the index. Well, that's okay, great. They're going to lower the payment. When they're not going to start it at the level of if you didn't have that potential, keyword potential, increase. They're not, okay? And you can't, please, please, please do not buy an index annuity with potential increase based upon what it did 10 years ago. You are a flat-out idiot if you do that, because that's ridiculous. I mean, you're looking at 10-year Treasury rates 10 years ago and basing your decision on that. Well, hey, Sparky, the 10-year Treasury is less than 1.5 right now. So you're making a decision on zero. So you've got to weigh, okay, the increase is great, and my grandmammy and my grandpappy lived to 97. Super. That's fantastic. But you still have to say, if I took one without an increase and I took one with an increase, how long is it going to take? What's my break-even point to get to the level, the one without the increase? And typically, what Jimmy Dot and I have found is 6 to 9 years. 6 to 9 year break-even point. Do you really want to do that? Do you really want to do that? Now, I have a client, I swear to you, this guy's fantastic. He has one arm. I'm not kidding you. He's one-arm guy. I don't know how he lost his arm. I never asked him. But the point is, everything he buys from me is a SPIA with a COLA. Why? Because he says, Stan, I like to see it increase. Okay, that's fine. But that doesn't mean it's mathematically sound. Okay? So, we'll show you. If you say, Stan, I don't believe you. I think you're full of crap. Great. I'll show you both. I'll show you with and without, and you can see the math behind it, and you can make your own decisions on the benefit proposition of the increase and how long it will take. But just know this, insurance companies don't give anything away. Anytime you get a benefit that makes you feel warm and fuzzy, you're paying for it in some form or fashion, whether it's a fee or them lowering the initial payout. I went on a rant. I was on a soapbox there.
Oh,
that's
boy.
Definitely right. All right, one more, Jim.
More
one
sleep.
more question. I know I need more sleep. That's true.
Let's see. This is an agent is telling me every week about the interest rates dropping, and I will get lower income on the income rider. Is there any merit, and should I act sooner than later?
Never act sooner than later when someone pitches you that. Never, ever, 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 ever have someone say, you need to buy it now because fill in the blank. Never do that. Now, do interest rates play a role? Yes. Can you time it? No. Which means the agent can't time it either, which means the agent doesn't know what they're talking about. Yes, it does, but that doesn't mean you need to buy it. I would tell that guy, I'll just go buy you a car. Go buy the guy a car, because that's what he's trying to do. Now, nobody has a crystal ball. I mean, if interest rates move up, then he's an idiot, right? And you've got a case against him for pushing you and pressuring you to buy it right now. Here's my opinion. If you say, Stan, send me the income rider quotes. If you like the guarantee, then buy it. If you don't, then don't. But you can't time it, and I understand that the guys pester you every week, and all that means, if you really sit back and think, all that means, if that guy's doing that, is he doesn't have many prospects, and you're one of the 8 that he has in his Rolodex, because he doesn't have a computer. He's actually using a Rolodex. Okay? So don't fall for any pressure. There's never an urgency to buy an annuity. You're buying a contract. You're buying a contract. That's it. Either the contract makes sense or it does not make sense. So I encourage everybody out there to do 2 things you should do. 2 things. Hug and kiss your family. That's not one of them. But here's the 2. You should do that anyway. But get the book, Income Rider Owner's Manual, one of the best books ever written. Period. I wrote it. And number 2, get an income rider quote. Let us show you what an income rider would be. And we won't hold you anything. No obligation to say, Stan, let's see what it'll do if defer for 10 years or defer for 12 years or defer for 7 years. Let us know what you want to see, and we would need to know amount of money, how long you want to defer, if it's just you or you and a spouse, dates of birth, okay, and then IRA or non-IRA money. That's it. State it where you live, and then we'll run the quotes for you, and then we'll start the conversation. Hopefully, you'll get the book, you'll start learning about it, but don't fall for any high pressure. And a couple of things out there that you're going to see and hear. Nobody has a product that anyone else can't get. If someone says they have an exclusive product, they're flat out lying to you. It's a flat out lie. If I don't have an exclusive, nobody does, and I don't have an exclusive. Period. I'm Stan the Annuity Man. I should have an exclusive at all. Okay? These are commodity products. Now, what we do provide is we represent every carrier on the planet. So we can get the highest contractual guarantees to you so you can make an informed decision.
And I don't think you can emphasize enough the issue relative to what Stan just said, in that fact that this is, what do you want? Income now, income later. When do you want it? And that's how you make these decisions. This isn't, there's no magic to any of these products. There's no magic to any investment product. And if anybody ever tells you there is magic, please get in your car and leave. It's not worth the conversation. I've been around this industry for 33 years, and I've heard all the stories, all the lies, all the pontifications, and the sex appeal that people attach to products, whether they're mutual funds, REITs, MLPs, annuities, it doesn't matter. There isn't a product created on the face of the planet that will not be here tomorrow if it's a valuable product. In other words, if it's going to offer value, then it will still be here tomorrow. The urgency of you making a decision is there for one reason and one reason only, and that's generally the person on the other side of the table wants to get paid. If somebody's pressuring you, you need to find someone else or some other way to deal with your money, because it's honestly not worth it. That you will make a bad decision, you'll make a wrong decision based on that. Decide what you want, decide when you want it to happen, and work towards that. That's really as simple as it gets, and I tell people that every day. All right, Stan, you have 2 more slides you got to get through.
All right, let's go quickly through those. Confined to care doubles, we talked about this. You're getting your money back faster. It's not long-term care. If someone says it's long-term care, they're lying to you. Long-term care is a health care product. Okay, this is a life insurance product, so it's not long-term care. It is what it is. You're going to get your money back faster. Don't put a lot of weight on it. We saw one of the worst things ever, Jimmy and I, a lady that got sold by somebody. They put her in an indexed annuity with a rider on a doubler because she said she needed long-term care. Honestly, that guy should go to jail. Do not buy the income riders for the doublers, okay? It's nothing more than supplemental coverage. If anything, you're just getting your money back quicker, great, but don't put a lot of weight on it. But let's go to the last one, which is important. Annuities are guaranteed by the claims paying ability of the carriers. That's very important to know, and that's where you should base your decision. Now, each state, and this came up to us, we wanted to talk about this because I get these questions a lot. Each state has what's called a guarantee fund. You should never, ever, ever buy an annuity based on the guarantee fund. Okay, let's get that out of the way. But each state does have that, and they back annuities up to a specific level. So in some states, let's say it's $250,000 of the accumulation value. Let's just slow down right here. Income riders are not covered by the state guarantee fund. The right-hand side of the ledger is not covered by the state guarantee fund. It's the left-hand side of the ledger. There's only one exception, and that one exception is a guaranteed minimum income benefit rider, which is an annuitized rider. If the product has been annuitized, then it's covered up to that amount. But let me give you an example. Let's just say there's $270,000 in your income rider side, the right-hand side of the ledger, and there's $220,000 in your accumulation value side, the left-hand side, and whatever reason that company goes out of business, etc. You're not going to get 250. You're going to get the 220. You're going to get the left-hand side of the ledger. The drawdown income riders are not covered by the guarantee funds. So it's important to understand the claims paying ability of the carrier, the solvency ratio, et cetera, which Jim and I can help you. But I hear that one a lot, that these things are covered. They're not. Only the annuitized GMIB riders, which, by the way, are not even competitive if you looked at annuitization rates. They're not even competitive. It's almost a bailout if your mutual funds go bad on a variable annuity, but that's a whole other story for a whole other day. But just know that that right-hand side of the ledger is not covered by the state guarantee funds. That's key. Understand it. So, Jimmy, close us up here, and then I'm going to sing this. I got a great way to close this thing out on the title, but give them the details.
I can hardly wait.
It's going to be great.
A couple questions about whether or not we're going to post this. Yes, this will be up in the next 24 to 48 hours as soon as we can edit the video. We're going to have to take out how many times people were called idiots tonight.
Come on. They took it the right way. I'm trying to wake them up out there.
But so that will be up on the site. So if you just go to annuities.direct, you just go to Go Direct News on the site, and you'll be able to find that right there so that you can replay the video, which will cover everything that we've covered tonight. If you have any questions, you can email us, obviously. You can just go to the website. And by the way, please be aware of the fact that when you type in annuities.direct, that when you type it in, it is annuities with a dot, and direct replaces com, so it's annuities.direct. That's the actual URL, so that you actually can get there. The podcast you can see are on here. The webinars will be on here. Everything is there relative to you that you want or
National
need.
figures, Jim. National figures on our webinar, our podcast. All the friends of annuities.direct.
Absolutely. And so if you want to ask questions, you can go to Ask Direct. That will take you back to the screen where you can type in the question. And please, Stan, repeat for them what you need to run a income rider quote if they want to get one.
Dates of birth, if it's joint.
What do you need?
Date of birth.
Date of birth.
Amount of money. How long do you want to defer, and what state you live in. It's that simple. And I will go crazy. I have the best staff on the planet, annuities.direct, best staff on the planet. Jimmy Dot and I have handpicked these people from all over the place. Now, here's my close, Jim, because we're running out of time. Sex, lies, and income riders. The sex is the supposed return on the left-hand side of the ledger. That's the sex. Yeah, you can get market returns and no downside. That's sex, okay? The lies is, well, you're getting a 7% return. That's the lie. It's not. It's monopoly money you can use for income. But understand this. Income riders are fantastic for future income needs, income later. It's a flexible product. It's customizable to your situation, and it's a commodity that you need to quote all carriers. And with that, Jim, I think that was just a beautiful poetic soliloquy on the out.
That's how you submit it. Put the date of birth, amount of money, state you live in, and put your, not my name, please put your first and last name and your email address.
And how long you want to defer, and we're off and running.
You just click submit, and that's how easy it is to get it. We are building a site that you'll be able to do it yourself. That'll be ready soon. And if you want to subscribe and be a part of Income Investor newsletter, you can do that on the site as well. So all of those things are available to you. We hope that you've enjoyed tonight, and we'll be back